SoFi just released their third quarter financial results yesterday before they bell, and they crushed all analyst estimates like usual. They marked their fourth consecutive quarter of profitability, and yet, despite this, the stock traded actually down throughout the day, despite surging to $11.99 in pre market. After having had 24 hours to digest the earnings report, in this video, I'm going to be doing a full breakdown of SoFi's third quarter earnings and go in depth into each individual segment. Let's jump right in. As usual, let's break down the earnings into sections, starting with lending and moving on to financial services and the tech platform, and then moving on to the company financials and guidance as well. If you're interested in staying up to date with SoFi, please make sure to subscribe to the channel as I make SoFi content on a regular basis. So let's first start off with a wide overview, right? Like the high level numbers relative to analyst estimates. We know this company has a very rich history of beating analyst estimates, and this quarter was no different. Q3 saw SoFi report 697 million in GAAP revenue, beating analyst estimates of 631 million, also beating the top end of their own guidance by over 50 million. And for revenue, as well as most of the financial results, SoFi came in even higher than any of our expectations on the SoFi Weekly podcast, and generally we're pretty much closer than any analyst is on the street. My own revenue estimate was 664 million, and SoFi came in over 30 million on top of this number. In terms of the bottom line, many analysts expected 4 cents EPS, and SoFi beat this number as well, coming in at 5 cents EPS with 61 million in net income. Again, this was a beat from management's own guidance, where they had forecasted 40 to 45 million for Q3 net income, and they came out and they reported 61 million. My net income estimate was 55 million, so it actually came in above my estimate by 6 million. In addition to this, they also raised their guidance for the rest of the year, and I'll talk about that. But first, I want to jump into some of the main metrics, starting off with the leading indicators in members and in products. SoFi saw new member additions of 759,000, bringing the total members to nearly 9.4 million, up 35% year over year. My prediction on members was only 6,000 members off. I had 750, they came in at 756. And the reason my prediction, I think, was close is because we have to have a step change in terms of how we think about SoFi. I've talked about this in previous videos, and especially when I presented my predictions in the first place, is that in order for SoFi to post growth in a tough comparable quarter, such as Q3 of last year, where they reported 717,000, and for them to stair step towards that 1 million member quarter that Anthony Noto has talked about in previous interviews, they have to consistently be breaking these same records in member additions. Now, I mentioned on the previous earnings recap for Q2 that I don't think we're going to see a 5 handle for SoFi again. And what I will say here for this video for Q3 is I don't think we're going to see a 6 handle again for SoFi. And yes, that's a bold statement because they could come out next quarter and they could report 650,000 or 680,000 members, and that would not hold true. But I really do think that 700,000 will become the new floor for members, because in the back of my mind, I'm always thinking about that stair step upwards for the business to get to higher member counts. And I'll even double down and go one step further than that and go out on a limb and say next quarter is actually going to be a record-breaking quarter in terms of member additions, meaning more than 756,000, because they essentially have to do it, number one, but also because this quarter they had a lot of help from the NFL season starting. Next quarter, they're going to have the NFL plus the NBA. And then Q1 of 2025, they're going to have the NFL, the NBA, and the TGL Golf League all running simultaneously. So that's really going to be, my member prediction push for 1 million members is going to be that quarter most likely. Now, in terms of products, we know that this goes fairly in hand with members. For Q3, SoFi added almost 1.1 million new products, bringing their total to nearly 13.7 million. This is a 31% year-over-year increase. Again, here my prediction was only off by 12,000 products, but that's only because it goes hand in hand with members. Once you understand the relationship between members and products, it becomes fairly straightforward to forecast both numbers out and be within a realm of accuracy. Now, I'll skip the Galileo counts for now and cover them all talking about the tech platform all in one, and I'll jump straight into the product breakdowns by segment. So just as a primer for those of you who are not invested in SoFi and somehow found this video, SoFi is a business with 3 main segments. They have the lending segment in personal loans, home loans, and student loans. They have financial services in SoFi Invest, SoFi Money, SoFi Credit Cards, Relay, SoFi at Work. And they also have their B2B side of their business, which is the tech platform. In terms of the product breakdown, we're only looking at the B2C segments, so financial services and the lending platform. This quarter, the lending segment specifically grew 19% year over year to 1.9 million total lending products for Q3. This is the second quarter in a row where they posted a 19% growth rate. In terms of financial services, they grew 33% year over year to 11.8 million financial services products. And I've mentioned this in the past, but I also want to touch on it again here because it's so clearly becoming a bigger and bigger trend every single quarter. Financial services is now 6 times as big as the lending segment. And we know that the lending segment is SoFi's biggest from a revenue generating perspective, also from a profitability perspective, but financial services is growing at an 80% plus clip for the foreseeable future. In fact, this quarter it grew over 100%, which we'll talk about in just a second. So really here, from a product perspective, the growth in financial services is incredibly impressive. And if I just put up the productivity loop on the screen right now, this measures the ratio between financial services and lending products. And what you can see here is that the ratio is constantly expanding every single quarter, every single year that they report. And this trend is definitely going to continue. We have 6 times financial services products today than we have lending products. I wouldn't be surprised that, in 3 or 4 quarters from now, we have 10 times more financial services products than lending products, and so on and so forth. And logically speaking as well, it also makes sense, right? Because financial services products have fewer barriers to entry as a product line. It's much easier for me to open a Relay or a SoFi Money or a SoFi Invest account relative to the difficulty it is for me to get a mortgage with SoFi or a personal loan with SoFi. And because it's so easy, you have more and more people cross buying. They say, okay, well, I'll try another product with SoFi because it doesn't cost me anything. It's free to open. I'm already part of that ecosystem. I get rewards by being a SoFi Plus member. So why not? And people start adopting financial services at a much faster clip. And while I'm on this point, I mentioned in the earnings live stream, as well as in this bootleg weekly yesterday with Roy, that the more dominant financial services becomes, especially as a percentage of the total revenue mix, the more diversified SoFi becomes in the eyes of the market. The market is not seeing SoFi just as a predominant lender anymore. They're seeing them as an all-encompassing end-to-end financial institution, fintech company, if you will. Okay, so now that we got that out of the way, let's drill one level deeper into those lending products to see by segment how does lending break down. As we said, there's 3 sides to lending. There's personal loans, home loans, and student loans. If we look at by segment, of those 1.9 million total lending products, we can see that the majority of growth was yet again in personal loans, which grew 23% year over year. Now, that's a little bit unfair to say, right? Because personal loans has a massive advantage over mortgages and student loans because it's so much larger than the other 2 business lines, right? So it's going to be very difficult for it not to be the main driver of product additions in that segment. And I also think the loan platform business is going to become an increasingly bigger focus. I saw a lot of questions from analysts on the earnings call were around the loan platform business. And it's going to be top of mind because people have to model out how does this look in the financials and what could I feasibly expect SoFi to make from a profitability perspective off the back of this loan platform business as we go into 2025, right? Not to mention the Fortress deal, I think is top of mind for people still. They're still thinking it through. How do they model that out? And what does that actually equal in terms of the financials? Student loans grew 9% year over year, and home loans, which is dramatically smaller than the other segments, grew 19% year over year from a product perspective. These are very similar numbers to what the product additions were in Q2 by the business, so there's no real surprises there. Let's now flip over to the lending segment financials. Revenue for lending was up 14% to 396 million. This breaks out into net interest income and non-interest income. And just a quick recap, again, I do this on every single earnings breakdown video because there's new people that watch. Net interest income is the money that banks make from loaning out money. So for example, mortgages, personal loans, so on and so forth. Subtracting what they pay people who deposit money in the bank. It's essentially like profit that banks make from the interest on loans. By contrast, non-interest income is all the other ways that banks make money. It includes things like fees you pay for services. So for example, account fees or transaction fees. It includes money that they make from trading, income from services or investment advice or insurance. It's basically any money that is not lending. So net interest income was up 19% to 316 million, which offset the 5% decline in non-interest income. And non-interest income has been declining now for quite a long time on the lending platform, and that's deliberate, right? Because they want to lean more on that net interest income side. Now, let's subtract the expenses, which only increased 10% year over year to 152 million. And after subtracting those expenses, we can see that the profit for the lending segment came in at 238 million, up 17% year over year. Note here that the segment growth and the contribution profit are both growing at a faster clip than the expenses are growing. This signals some operating leverage in this segment, particularly. The actual margins for the lending segment also increased to 60% from 58% last year. And I think the strength in lending was unexpected in large part by the market and a huge reason for SOFI's beat. Now, in terms of originations, total originations increased 23% for this segment. Again, unsurprisingly here, driven by personal loans, although it's great to see the demand for both student and home loans coming in strong. Personal loan originations came in at 4.9 billion. This number was up 26% and 17% up quarter over quarter. They mentioned in the report that this number was inclusive of the 1 billion originated on behalf of third parties for the loan platform business. Management mentioned on the call that the loans they originate on behalf of third-party partners, they wouldn't have otherwise originated. So basically, an analyst asked them on the earnings call what they can forecast out in terms of the financials for the loan platform business. And Anthony Noto said, quote, "These are loans we wouldn't have otherwise originated, and we only originate when we actually have a contract. So it's not a zero-sum game, it's incremental. The outlook for it is pretty significant as we go into 2025 in excess of what you articulated." So that's really bullish because how I heard that is to say that it's not cannibalistic to SoFi's own originations. It's something that they wouldn't have otherwise originated, and they're only doing it because they have a contract in place where they essentially collect a fee on what they originate for their third-party partners. And just looking at this number from an originations perspective, if we just add up the numbers that SoFi originates on behalf of third parties, we can expect personal loan originations to stay elevated for quite a while and even form new highs. In terms of student loan originations, they were only up 3% year over year. However, that number is up 28% since the last quarter. So there is some acceleration there. And finally, home loan volume came in at 490 million, up 38% year over year and 17% quarter over quarter. Now, in terms of those loan sales, exclusive of the 1 billion loan platform sales, they reached 1.3 billion in total in loan sales and almost 5 billion on a trailing 12-month basis. So really, I think here the main story is that the loan platform business, I think, is going to evolve and change the narrative for SoFi as a business. And the modeling out that analysts are going to do for this business for future quarters to come, they're just finding their footing right now as to how they wrap their head around the loan platform business and what they could feasibly expect in 2025 from that loan platform business alone. You know, just from a macro perspective, let's not forget that this quarter that we're in right now for SoFi Q4, that's with a lower rate environment because the Fed cut rates back in September. And also for 2025, the Fed is going to continue to cut rates. And so management reiterated, even in their opening remarks and also in their closing remarks after the Q&A, that 2025 would be the best macro environment the business has seen over the past 7 years because they've consistently faced different headwinds from a macro perspective. But now it's finally seeming as though they're going into a favorable macro environment. And that's going to bode well, not only from, originations or from their lending side of their business, but from their entirety of their business with financial services as well, right? So that's definitely something that we want to see for SoFi because it marks an acceleration on these already very impressive numbers. Let's now move on to the second biggest contributor to revenue, which is financial services. Now, let's keep with the trend of starting off with products and moving on to the financials. We can see here on this chart that financial services product line items breaks down with SoFi Money being the biggest contributor of financial services products at 4.7 million products. Just SoFi Money is more than double SoFi's entire lending business from a product perspective. Of course, that doesn't mean anything because at the end of the day, revenue is what matters. But SoFi Money is a massive contributor to products. It's growing 54% year over year. And Relay, the second biggest contributor, is growing 42% year over year. SoFi saw a very slight contraction of 3% year over year in Invest, and every other segment grew by double digits, bringing the total product growth to 33%. Now, in the report, they did mention that monetization is also improving across all products, and I think that's very important to highlight because on an annualized revenue per product basis, It used to be $53 per product on an annualized basis. Now it's $81 annualized revenue per product. So they're making more money off of these products, and the products are growing all at double digits year over year. But of course, they have to be, right? Because SoFi is putting up these crazy numbers for financial services, and they're forecasting these crazy numbers well in advance for 2025. I mean, without SoFi money, we wouldn't have this crazy growth in financial services. And yes, between the APY that they offer and the 2 million FDIC insurance and all the other rewards, it does make sense for SoFi money to be their largest single line item from a product perspective. But don't forget that SoFi money also includes checking and savings accounts held at SoFi Bank, as well as cash management accounts. Deposits grew to 24.4 billion, with over 90% of SoFi money deposits coming from direct deposit members. So SoFi money is a huge backbone of financial services. And this also shows in the segment financials. Just looking at the numbers here, net revenue increased a staggering 102% year over year to reach a record 238 million in revenue for financial services for Q3. This is more than double what they achieved last year. And similar to lending, I mean, this also breaks out in terms of net interest income and not interest income. But unlike lending, both of these segments are growing for financial services. Net interest income grew 66% from 93 million, where it was last year, to 154 million as of Q3, whereas non-interest income grew 235% from 25 million up to 84 million this quarter. The report also highlights that among other factors such as interchange and referrals, a key driver of this income growth was the loan platform business, where SoFi essentially refers borrowers to origination partners and originates on behalf of third parties. This loan platform business grew 5x in the quarter and generated 55.6 million in loan platform fees. And this is why I say that it's going to require analysts to model out and not, I mean, they can't ignore the loan platform business because it's going to become a huge contributor revenue in a very quick amount of time. And I think now that we have some numbers to the loan platform business, we can actually see the puzzle pieces as to how SoFi will feasibly achieve these very aggressive growth rates in financial services. Because if you're excluding the loan platform business, it becomes very hard to feasibly think how they're possibly going to achieve 80% plus growth rates into the future. Now, blended for this quarter, it's 102% growth rate for revenue, whereas expenses only grew 20% for financial services. So we see the same exact operating leverage here in this segment as well. Contribution profit for financial services came in at almost 100 million, which is absolutely crazy to see. And just to put that into perspective for you, I mean, just the profit that they posted of 99.9 million is almost the entire revenue that they generated from financial services of last year. And look at the best part, the contribution profit. Last year, they barely broke even, whereas this quarter, they reported 42% contribution profit in financial services. I mean, that's when you get when expenses grow like 20 million and revenue grows like 120 million, right? The growth in this segment is absolutely the most exciting thing for SoFi, in my opinion, right now. And moving on from the most exciting to the most lackluster segment, the tech platform. Now, I have lots of thoughts on the tech platform, and I've mentioned this in the past. And, I do think that the tech platform is really their longest dated bull thesis. If you think in the short term, it's lending, in the midterm, it's financial services, and in the long term, it's really that AWS to fintech narrative. And I think for as long as the tech platform is missing guidance, missing numbers, and not really banking on any large customers, any big logos that they can possibly talk about, SoFi management is not going to lean into that AWS to fintech narrative as heavily because it doesn't benefit them. Analysts can't really model that out. Tech platform is not going to move the needle as much as these other segments will. Even on the earnings call, there wasn't even a single question on the tech platform, right? Galileo accounts grew 17% year over year to 160 million accounts, up from 136. I mean, it's good, but it's not crazy numbers like financial services. Like if you look at SoFi Money growth, for example, and management did share some details on the call saying, quote, in our tech platform, we signed several new partnerships, including processing deals with two chartered banks of Mexico, and they deployed Cyberbank Core for SoFi's new commercial payment services sponsored bank program. On the earnings report itself, they did mention that the pipeline is stronger than ever before and that the investments they're making is expanding the market opportunity for them. And in the spirit of remaining somewhat objective, yes, it sounds good, But just looking at the numbers that they guided for at the beginning of the year versus the numbers that they're putting up right now for the tech platform, there is a discrepancy there. There is some difficulty there in the tech platform's growth. I think there's a very fair case to be made that the tech platform is underperforming expectations. So even if we look at the segment financials here, I mean, the technology platform segment net revenue came in at 102 million. I mean, that's still good because last quarter we didn't even break 100 million, up 14% year over year, contribution profit 33 million, and it increased 2% year over year for a contribution margin of 32%. I mean, yes, on one hand, they are still making a profit on tech segment, so I can't really complain. But on the other hand, increasing the profit by 2% year over year is not anything to be super excited about, right? Interestingly, not only is the tech platform the slowest growing segment of the business, it's actually the only segment where the margins fell and the expenses grew faster than the actual revenue did. And that's not something that we want to see. Let's very quickly now run through some of the business financials and then talk about guidance. So, in terms of the quarterly adjusted net revenue, where SoFi reported 689 million for Q3, we actually saw an acceleration in that year-over-year growth rate. So, if you look at Q3 of 2023 was 27%, and now we're at 30%. Even quarter over quarter, last quarter was 22%, and now we reported 30% growth. And even adjusted EBITDA accelerated to 27%. Last quarter was 23%. Q3 of 2023, it was 18%. So we're seeing some progress there from an acceleration in SoFi's business. And they actually included a new slide here this time around highlighting the trailing 12-month performance. Adjusted net revenue on a trailing 12-month basis is 2.4 billion. Adjusted EBITDA on a trailing 12-month basis is 650 million. And finally, my favorite number of this entire earnings report is net income of 214 million on a trailing 12-month basis. And that's exactly what you want to see, because from an analyst perspective, a lot of them are going to be arguing that this business is not profitable on a yearly basis. And now, if you look back 4 quarters, every single quarter is GAAP profitable for the business. And that's a massive step change, right? When you look at the year over year numbers as well, because I mean, we haven't fully closed out the year. We have to see what Q4 comes in. But even on a trailing 12-month basis, right, you look at minus 300 million on a GAAP basis because of the write-off to plus 200 million on a GAAP basis. That spread is absolutely massive for them to close out in a year. And that's obviously going to look very bullish, even to the most lukewarm analyst out there, right? We're going to see how it closes out the year when they release the numbers in January, but this is still a very good number to see. In terms of the guidance, they did raise it again. They kept with the trend. For 2024, SoFi expects growth over 80% in financial services. And yes, I do know that that sounds crazy, but keep in mind, this is the same segment that put up 102% this quarter. So 80% I think is not only very doable, but it's actually the only segment that SoFi doesn't have an upper threshold for. They actually just put a bottom threshold. They said minimum 80, and that can mean 81. It could also mean 181, right? So financial services is, like I said, the most exciting thing about SoFi for me right now is that growth and the potential that that growth unlocks for this business. Lending adjusted net revenue of at least 100% of 2023 levels. And this one was actually one of my forecasts. I highlighted that guidance would show that lending would be in the single-digit positive range for the end of the year. And remember, in January of this year, of 2024, they issued guidance saying that lending would come in at 95% of previous levels, basically saying that lending would contract. And guess what happened? The stock took a dip because lending was their biggest contributor to revenue. And if their biggest contributor to revenue is actually declining, it's actually contracting the business, well, then this is not a growing company. This is a value trap. And people sold off. In fact, lending is growing right now, right? And so that's something that we talked about for the whole year because we could see the writing on the wall. We know that this business likes to play the game conservative. They like to play their cards close to their chest. And in fact, with 1 quarter left on the books for 2024, lending is definitely on track to have a growth rate year over year. Now, of this 2024 guidance, the piece that I want to pick up is this third bullet point here. The tech platform net revenue percent growth of low to high teens versus 2023 levels. And if you just go back in the previous reports and you look through the verbiage, you can see that they've gone from the low 20% growth rate expectation in guidance to the mid to high teens expectation to now the low to high teens expectation in the tech platform guidance. Basically, they're covering themselves on the downside if the tech platform continues to underperform, which they are thinking it might. So this is why I say that tech platform is more disappointing. It's definitely their most disappointing segment on an individual basis. Now, just going through this list, they also have GAAP diluted EPS of 11 cents to 12 cents for the full year of 2024. And that's definitely a sandbag number because look, if we just add up the first three quarters, which we already have, we have 2 cents EPS in Q1, we have 1 cent EPS in Q2, and we have 5 cents EPS in Q3. Add those all up, that brings you to 8 cents. So what they're really guiding for here is 3 to 4 cents in EPS in Q4. You're kidding me. That's a huge sandbag. I would say 13 cents to 16 cents EPS is more realistic for this business because we know Q4 is going to be a very strong quarter for the business. And not to mention that most analysts had this business doing 8 cents EPS for the full year, and they came in at 8 cents EPS for the first three quarters, with one quarter, arguably their strongest, still yet to go. Now, if you suspected that they were sandbagging with that EPS number, look no further than the member growth guidance that they gave. 2.3 million members at least, or 30% growth from 2023 levels. Look, man, they've already added 2 million members through the first three quarters. So basically what they're saying here is that in Q4, we're going to add at least 300,000 members. Like, yeah, of course, we knew that. It's a no-brainer that they're going to add 300,000 new members in Q4. The number is going to be actually closer to 800,000 if we're looking at that step change that we talked about at the beginning of this video. So I thought that the guidance is definitely super conservative to the point where like it's very obvious that they're sandbagging their numbers, incredibly obvious, in fact. In terms of the earnings call itself, I thought it was concise, I thought it was confident, and I thought it was bullish from a sentiment perspective. My biggest takeaway there was management's comments that they faced the worst macro environments, the biggest headwinds over the past 7 years through the pandemic, through high interest rates, through the student loan moratorium, among other issues. And for the first time over the past 7 years since Anthony Noto even started at the business, they're going into a year in 2025 with the most favorable macro environment that they've ever had. So that's very bullish because you're looking at the crazy numbers that they're putting up in tough macro environments. Imagine how good this business will do in favorable macro environments. So that's going to be even more impressive. And that's the thing that I really come back to time and again is thinking about management is actually excited because they're going to put up even higher growth numbers. They're going to capture even more market share. And I'm thinking, you're already doing both of those things. How much more numbers do you want to put up? And so you really have to think differently about this company because some of these growth rates of where they want to go and the product announcements and everything that goes along with that is going to get accelerated even further. And we saw accelerations in the financials this quarter, but that's going to continue into 2025. And that's something that should excite every single SoFi investor. Now, I'm sure I'm going to talk about these numbers more in depth on the SoFi Weekly podcast, but throughout the day, Anthony Noto, the CEO, made some appearances on news outlets, and we got some analyst price target increases. Jefferies increased the stock. Bank of America increased their price target. And I expect more analyst upgrades to roll in over the course of the week as more analysts have a chance to digest these numbers and model them into their forecasts for future quarters. Overall, I think this was a tremendous earnings, record-breaking in so many ways for the business. And now we can officially call SoFi a profitable company on a trailing 12-month basis. Congratulations. I personally can't wait to see what they have in store for 2025. I mean, by way of guidance and also by way of product announcements, that's what I'm really excited for. We know SoFi did like 2 or 3 weeks ago, they had all of their leadership team planning for 2025, and they're going to be sharing some of that by way of guidance in January. So we're going to see what that looks like, what product announcements they're thinking about. I mean, they mentioned SMB a couple of times on the earnings call, so that's going to be exciting to hear about. And they're finally in a good macro environment. I cannot stress that point enough. I think it's my biggest takeaway of this earnings is management is really looking to accelerate these numbers. They're not sitting back, patting themselves on the back saying, oh, wow, we're crushing it here. We're capturing market share. We're beating all expectations. They're saying, oh, great. We're out of the woods. We can see the light at the end of the tunnel. We can actually now, for the first time, start to accelerate. And that's crazy to think about, right? Because we're all very impressed with the numbers that they're already putting up. Meanwhile, they're saying, you haven't seen anything yet. Now, in terms of the stock price action, yes, the stock did fall 10% on the back of those earnings, but the momentum is there. My bull thesis still stands. The stock regained a lot of those losses. It closed the day down 6%. And in fact, it's up 8% as I'm recording this. It's about 11 a.m. right now on Wednesday as I'm recording. So the stock is regaining that momentum. It's $11.25 right now. I think it's going to break through that $11.70 range very shortly. It's going to put up new 52-week highs, new 3-year highs. That bull case is still intact with that momentum building, with SoFi finding stronger footing in that double-digit range to fuel the next leg up. This will be a double-digit stock. It will be sustainably in the double digits. And I think that we're going to see that more accurately. I think that sell off was a last stand, if you will, by the shorts to push the stock down. 17% short interest on this company. That's going to be a risky, precarious position because almost everyone who's shorted this company is now underwater and the stock keeps going up. So we'll see. The market is finally starting to wake up to SoFi, finally starting to realize. And to quote management, this is just getting started. 2025 is going to be a great year. I'm very excited, and I would love to hear from you, your thoughts on the earnings. Thank you so much for watching. I will see you on the SoFi Weekly podcast on Friday and in the next video.